Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options trading program. Hit me with a like and share, subscribe. And if you want to learn more about the highest paid part-time job in the world options trading program, you're serious about getting the results from being an actual options trader, the link should be in the description. The link should be somewhere in the comments. If you have any questions, hit me up. It's going to be for serious people only, right? And so what we're going to do is we're going to talk about the cruise line stocks. And I think this is going to be really, really interesting conversation because this was an area that was really, really affected by COVID. And they weren't able to get any relief because they're really not American-based companies. They may port inside the United States, but I think they were registered in other parts of the world because they were trying to get around paying U.S. taxes, which was smart until you needed relief from the United States, right? And then they no longer had access to that relief bills or those type of relief funding. And so what we've seen is that they're anticipated of making a recovery from COVID as a result of people starting to get vaccinated, them vaccinating their crews, them having some type of COVID testing. However, to keep the companies afloat and to keep the companies viable during this time in which they were not allowed to do business under recommendations from the CDC, and I'm also worrying about lawsuits and things of that nature, they had to take on a lot of debt to keep the company going. So what we're going to talk about is that particular scenario and whether or not we think that they're a good long-term investment based on some of the things that are going into these companies internally. So from looking at the cruise line industry, we have three major companies. That's going to be Carnival, Norwegian, and Royal Caribbean. Give you a disclaimer. This is not investment advice. I'm not an investment advisor. I'm not a fiduciary. What I want to tell you is make sure you do the research. Make sure you manage your risk. This video is primarily for entertainment and also education or information. So let's get into it. So this particular article from Barron's, and this is why reading is really, really so important and trying to understand how to take the information that is relevant to the scenario and kind of cutting through the noise. We're talking about the cruise lines, and they say that few industries have raised as much money during the pandemic than the cruise line companies. And one of the reasons why they had to raise so much money is because they could not operate. So unlike a restaurant, let's say Darden was able to operate at some type of limited capacity during COVID. So they maybe had to cut down the dining room, but they still was able to do takeout. Because I would go by like down in the Southeast, Darden's real big with this Italian eatery called the Olive Garden, where their drive-through, not really their drive-through, but their takeout was doing really good business, right? So if you just was really pressed to eat at there and you wanted to sit outside and wait for them to bring you your food, you could still do some type of business with this operation. Where the cruise lines really couldn't do any business. So as a result, they had to try to raise money to keep things going until they could get the boats back on the water and moving around again. So they talk about these particular operators raised around $40 billion through debt and equity sales. And they didn't get any help from the stimulus bills. Why? Because even though they operate out of Florida primarily, they will be called domiciled offshore in tax havens and pay no material U.S. income taxes. And I don't have a problem with that. I wouldn't. If the United States is going to allow me to operate out of their country and not pay them U.S. taxes, I say go for it. But as a result, they weren't able to get any kind of financial help from the federal stimulus bill. So what they had to do was go to the private markets and try to figure out how can they get some money to ride this out. Now, as an investor in these particular companies, and as somebody that is maybe trading these companies and trying to understand how the market is going to perceive them, the problem is that they now had to take on debt, which means they have higher interest expenses, right? And then also what they did was a lot of times some of them issue shares, which what it did was it expanded the float, which is going to lower earnings per share because now you're dealing with a larger amount of shares in the market, even though the revenue is not necessarily going up in proportion to the amount of shares that was issued. So we talk about Carnival's net debt, for instance, is expected to rise around $23 billion. Current fiscal year up November, up from $11 billion at the end of 2019. So they're going to increase their debt by $11 billion from the end of 2019. The interest expense is expected to be 1.7. It's up from 200 million in 2019, and the shares outstanding are up from 1.7 billion from around 700 million. So from 700 million to around 1.1 billion, that's around 400 million more shares if my math is correctly. Now, what we want to understand is that because of this scenario, right, in which they have so much interest expense because they got to pay back debt, dividends, which is going to be very, very important to people that want to own their shares, are probably going to be off the tables. And then also share repurchases. So you would want them to decrease the amount of shares that are available, because what that's going to do is that's going to raise the earnings per share, and it's going to make the shares that current investors hold, make them more valuable. That's primarily probably going to be off the table. So if you're owning these cruise line stocks, you know that they're not going to issue a dividend. So the question is, what would make the stock attractive if a dividend is never going to come from it? We also understand that many of them have increased the amount of shares in the market, which is going to lower the earnings per share, which is going to lower the actual value of the shares. It's going to kind of dilute their shareholders. And they also, because of interest expenses, are not going to be able to do share repurchases. So then the question is, what would make these companies valuable except believing that the shares are going to appreciate to a certain point? And we're going to kind of go to the charts and look at that also. Now, the bull case is that, right, the cruise lines are going to benefit from pent-up demand as more people get vaccinated and the economy opens up. And Carnival reported last week they did a $2 billion loss for the quarter. So they lost $2 billion over the last 90 days. Okay, over a 90-day period that they're reporting as their cover. But we also are seeing is that they've recovered, and the shares over time of Carnival, Norwegian, and Royal Caribbean have rallied. And as the economy starting to open more and more up, we definitely believe that they're going to rally. But that's the bull case. So the bearish case is what? They can't do dividends primarily because they got to pay back interest. It's very unlikely they're going to do share repurchases. So then what is going to make that company attractive outside of the pent up demand? Because we're talking about pent up demand. Once that demand is serviced and we go back to the normal, right, seasonality and the normal revenue patterns, why do you want to own these stocks? Okay. So they talk about this guy at Truist Securities. The market is banking in a full return to selling by next year, and that 2020 will only be a normal year, but one that is better than 2019, which is also questionable. So now I want you to understand what is being said. Before COVID, they did a certain amount of revenue per year, right? Before COVID. COVID killed their revenue. There's pent up demand because they haven't been able to operate. That demand eventually will get serviced. We will go back to normal revenue patterns, right? All businesses have some level of seasonality to them. The question is, when we go back to doing normal business, let's say 2023, let's say everything, let's hypothetically, let's say top of 2022, January, everything goes back to normal, right? Will those revenues in 2022 be greater than the revenues in 2019 before COVID hit? Because if they will not be, what is the reason why you would want to own this stock? Because we talked about before, it's unlikely they're going to be able to put out, issue out dividends, which is the reason why some people own stocks, because they get paid to own the stock. And it's unlikely they're going to do share repurchases, which means that the people that got diluted as owners of the stock are not going to be able to see their earnings per share and the value of their stocks go up, because there's less stocks in the market for people to own, which means that the people that actually own them, the shares become more valuable. So what is the bearish? That's the bearish case for owning it. So pent up demand is the bullish case. But like I say, you always got to create a bullish and a bearish case, right? So he has a sell rating on Carnival. He got hold rating on Norwegian and Royal Caribbeans. Now, Carnival at this current time is is trading at $29. That's about 17 times projected 2023 earnings. So we understand that the market is a forward-looking mechanism. So it's trading at 17 times projected future cash flows. 2023 earnings per share 167. Norwegian at 31, 13 times estimated 2023 earnings, and then Royal Caribbean at 90, 15 times projected 2023 earnings. Now these are very optimistic earnings. And this guy, Morgan Stanley analyst Rollo, says we doubt the industry will be larger or more profitable than it was pre-COVID. So he has below consensus energy earnings projections for 2023, because so what we're saying is that a lot of people are projecting that their earnings are going to be greater than pre-COVID. This guy from Morgan Stanley, the analyst, is saying that he doubts the industry is going to be larger or more profitable than it was pre-COVID, right? Then we want to talk about that there may not be meaningful cash flow until 2033 or 2024 because of interest expenses and still lofty capital expenditure as the industry seeks to refresh a fleet that has an average age of more than 10 years. So what we want to understand is that they may have to do capital expenditure or capital budgeting to either retool or buy new boats because the average age of their boat is greater than 10 years. So what is that going to do? That means they got to spend even more money. So now outside of the debt they took on to try to maintain themselves during COVID, we know how it is. Let's say you got a car, well, you got to pay money to keep the car going. So buying a car really is an expense. Now the car can make you money, but you also got to put money into it. So with their boats, not only do they have to, get the boats redone, keep the boat serviced, you're going to reach a point in which you got to just buy a new boat. And I guarantee the money to buy the boat is very expensive. So they probably get that financed, which means what? Now they even got even more debt. So if you start looking at their balance sheet and understand how long do they normally depreciate a boat, if we can find it in their balance sheet or in their financials. So they buy a boat. How long does that boat normally get depreciated before it becomes zero and they start looking to get a new boat, right? Where are they at in that particular time period right now in their company? Because then that can be a major expense in one of these three companies that may be coming up, right, that you have to account for as an investor. So then we talk about their enterprise values, which are expected to rise significantly as a result of debt and equity sales during the pandemic. So we talk about Carnival Cruise Line. Net debt and bill 2019 is 1117, 2021 to be 2290. Shares outstanding continue to go up. The enterprise value also continues to go up. Now, Carnival talked about in their first quarter that booking volumes accelerated in the first quarter were 90% higher than in the fourth quarter, which I understand, right? And bookings for 2022 are running ahead of a very strong 2019. I had somebody tell me a few weeks ago that the cruise lines are pretty much just giving away cruises. They just trying to get people on the boat, and they're trying to really get you to buy early, because the cruise line industry was really about you putting a deposit down for a future cruise and then paying it at a later date. So they were able to actually capture that revenue early, right? As opposed to having you pay at the time in which you were getting ready to take the cruise. That's kind of how their business works. They're an event-based business. And when you're dealing with a lot of events, where you have to secure a spot somewhere, a lot of times they make you pay ahead of time earlier before the event actually takes place, or else you're worried about not able to get a spot at that event. So that's kind of how their bookings work. Now, what else we want to talk about? The cruise. So we talk about Norwegian. 2019 net debt is 660. 2020 net debt is 850. 2021 estimated net debt is 930. Shares outstanding continue to go up. Enterprise value also continues to go up. Now, the reason why investors are going to the cruise lines is because they're one of the few groups of stocks in the travel industry that are still below pre-pandemic levels. So a lot of the stocks in the travel industry have pretty much gone up or exceeded their pre-pandemic levels. For the cruise lines, they're still below that. But the question is, there's a reason for that. And one of the reasons is for that, the fact that they're holding a lot of debt. Many of them not going to be able to issue out a dividend because they got to spend that extra money to service the debt, right? And then also they expanded their float, which means that the people that are currently holding the shares or were holding it before they expanded got their shares diluted. So you're kind of buying into that. So unless they can figure out a way to really ramp up revenue and to make revenue greater than it was before COVID, why do you really want to own their stocks? Now, the three cruise line operators have projected year-end enterprise values, which is equity value plus the net debt, that are above where they stood at the end of 2019 as a result of high-end debt and more shares outstanding. So they're saying that investors are attracted to this because they're below pre-pandemic levels. In Carnival instance, is 40% below a price of $50 a year in 2019. However, the cruise line operators are telling people that enterprise values, which is equity value plus the net debt, are above where they stood at 2019 as a result of higher debt and more shares outstanding. So it's a contradiction where people want to get in because they feel like it's going to continue to appreciate. But the cruise line operators are telling you that the equity value, right, represents the fact that they have a lot of debt and they have more shares. Now, one of the biggest challenges for the industry is that the Centers of Disease Control have not set a firm date for resumption of voyages, right? But they're saying that it may happen by midsummer. Okay. Norwegian wants to start in July. So they're pushing to get back on the water. Why? Because you got to bring in some money, because you got to pay this debt off. So you got to start bringing some money in to service this debt. Same thing here. You can look at Royal Caribbean. Net debt continues to increase. Shares outstanding continue to increase. Enterprise value, even though I think Royal Caribbean probably is in the best position of the three companies. So this is what we want to look at. These companies had to issue out a lot of debt. They had to also probably expand the amount of shares or try to raise capital to get through COVID. If you're looking to buy into this company, is this a 5-year or is this a 10-year hold? Right? And the question is what we talked about before. Once the pent-up demand is taken up and they go back to their normal revenue seasonality, right? How does that debt affect share value? Because every quarter you got to deal with the fact that we got to pay off this massive amount of debt. And they can get some of that debt negotiated, maybe bring it down a little bit. But they had to issue out a lot of debt to keep things going. And they still have not gone back to business. So it's estimated we're going back to business in July, but it's not July yet. So we don't know. We can't really predict the future. July can hit and the CDC can say, you know what? We don't think anybody should go back to business until top of the year. Right? So you got to really understand that. So let's look at the charts real quick. Looking at Carnival Cruise Line, okay? What we're seeing is this is COVID. Now, what I want you to see of Carnival, and we're going to kind of examine this to the other three companies. They around, what date is this? This is around 2018, 129. They're around $70. And what we're seeing is that they just started falling off that cliff. Now, we may want to go do some research and understand why did this take place? Were they putting out really, really bad earnings reports? What was going on in the market, or what was the market's perception of Carnival where they continue to just fall? But what we see from this point, and so this is the 5-year, so each candle's a week, right? They came up to this point, and then they started to fall back down. They started to sell off at around $69, $70. Now, here's COVID, right? So COVID, they were open at around 40 for really COVID started a little bit earlier than that. But here's when they started to sell off because of COVID, right? And I keep telling people, like, we made more money during this time than any time of 2020 because these are weekly charts. So each candle represents a week. See how red this is? So this is selling off. So they started here and started moving down. And then when COVID became a reality and people realized how it was going to affect their business, it started to sell off really hard, and it stopped around, that's around $12. Came a little bit lower because I remember it got closed around $8.49 and it started to walk their way back up. So it closed at $29.30. So we're looking at around 2019, they was in the $50 to $60 mark. So a lot of people see that all this space now in between, they see this as where it could potentially appreciate once they get back to business, right? But the question is, does it ever get back up here? And then also, how long will it take? So I think definitely you get a bump in here once they resume selling again. But the question is, if this was like pretty much almost their 5-year high, right? If this was like their 5-year high, it took years to get back to here. It took years to get here. Took literally years. We're talking about 2012 was around $31. Took years to get here. Well, how long is it going to take to get back there? Well, and so that's why I say this may be a 5 to 10 year hold. Now let's look at Royal Caribbean. Now we're looking at a little bit of a different chart. So this is Royal Caribbean RCL. They closed Friday at 89.88. What we're seeing on their 5-year is that they walked themselves up out of a hole, sold off real hard, but around the $69 mark, which is, what year is that? 2017. They came up and they got around this 128, 129. And then what we're kind of seeing, and you're going to see this on both the charts, is you're seeing this might just be seasonality, where you get an increase in revenue, a sell-off increase. This is maybe seasonality. But what are we seeing here? This is COVID. Now, what's interesting, and I want to point this out, a lot of people, and I'm not here to disrespect anybody. Everybody got their own, perspective of the market and how they see it. If you believe that this company was on sale during this time, you got caught in a wood chipper, because it just kept selling. So we got to always take things in context. I don't believe in universal rules in a lot of scenarios, but especially the market. There is no, buy the dip shouldn't be, it becomes a platitude. It becomes like a colloquialism. It becomes like some type of Pavlovian programming where people think, if I think it's a solid company and the market turns red and it starts selling off, it means buy it. The problem with that kind of thinking is in this scenario, it doesn't stop selling, right? So even your RSI would tell you that it's oversold on a weekly. Don't matter. These are weekly candles. Red, went green. I guess everybody figured, hey man, we got in at a great time. It's getting ready to bounce back up. Red again, and then red again. So you got literally 1, 2, 3, 4, 5, almost a month of selling. So if you buy the dip, it just keeps dipping. So if you bought the dip at around 32, right? Yeah, you're at $80 something now. You're around $80 something, right? So if you bought the dip at around 32, you're at $80 something. Okay. But if you bought the dip at around 111, you're at $80 something. And it took from 2/3/2020 to almost really past this time last year to get past that, to not even get to that point. So if you bought it at 111 on the dip at 2/3/2020, and we're at 4/10/2021, we're still not at 111. So this is why I'm not a fan of just thinking, well, if the company's selling off, it's on sale, because there's a reason why this sold off like this. But what we're seeing is that this sold off. So the question is, does it ever get back to this 135? Because how long did it take to get to 135? Right? How long did it take to get to that? It took a really, really long time. So we're looking at what week? This is 2013. It took years to get here. Now it's recovered fairly quickly. But the question always is, where did you buy in at? Because like I said before, is if you bought in here, you're still waiting it to get back there. And it continued to sell, came up, sold off again. So that's why I'm not a fan of buying the dip. Now here's look at Norwegian. If you look at Norwegian and Royal Caribbean, their charts look really similar. So let me back out. Look at this one and look at that one. They look very similar right before COVID. So like I said before, this may just be seasonality in the market that causes, these sell-offs, people buying it back in and selling back off. But you see the same thing. You see weeks and weeks and weeks of selling, right? RSI is going to show this oversold. Don't matter, because you got to take everything in context in the market. There is no universal hard and fast rules. Everything. That's why when people try to create these systems to do stuff, there is no system. The system is everything is a unique scenario, and you got to take things into context. What is going on in the overall macro market that's affecting this micro ticker? So what was going on in the overall macro where the whole SPY was selling off? This is when they was halting the market. So if the whole market is selling off, right, the fact that the RSI on the technical indicator is showing oversold is not important. Okay. So I want you to understand is that how long does it take Norwegian to get back to this point, which is around 59? Okay. So let's say Norwegian 2013 is high 60, its high was 59, right? Some seasonality, sells off real hard. We close it around $30. It's not going to take it as long as it's going to take Royal Caribbean, right? So if you bought here at 46 at 2/16/2020, which is around a year ago, you're still waiting it to get back to that point. Okay. So if you're buying into it now, because you do got a lot of upward ability, you have a lot of potential for it to move upward back to the $60. But the question is, how long are you willing to hold it? Because we talked about before. And if you look at this article, so that's Norwegian, right? This is Norwegian. This is their net debt. It's going to continue to go up every year, right? Shares outstanding continue to increase. So the enterprise value is going to go up. Now we're assuming the analysts are giving projections that revenue is going to be greater than it was 2019. But there's some analysts that don't believe those projections are accurate. So in a scenario where, let's look at Norwegian. Let me look at something real quick. Okay, so Norwegian doesn't give out dividends, or it has not given out dividends for the past 5 years, right? So they don't give out dividends. They got a float of 314 million. They don't give out dividends. Let's say hypothetically to raise more capital, they got to do another issuance of more shares, but you own Norwegian. What happens then? Because you don't get a dividend for owning the stock. So these are the kind of questions you got to ask yourself. Is it on sale? Yeah, it's on sale for a reason. Most things are on sale for a reason. When you're looking at the car market and they say, hey, you know what? We slashed car prices by this many $100 and we're going to offer this rebate. You know what that means? It means the cars aren't moving, because they don't cut prices on any luxury car or a car that's actually selling. So things are on sale for a reason. And like I said, is you got to always take into account the macro and then how that affects the micro. So this is why I do these particular broadcasts, because I want you to understand the market outside of a colloquialism. I don't think you're dumb. I don't think you're stupid, right? That's not why I've tried to build a following on YouTube, because I think I'm talking to a lot of stupid people. I don't think you're dumb, but I don't think you're stupid. In fact, I think you're extremely intelligent, because a lot of people that have taken my options trading course, they don't have the formal credentials of really intelligent people. But in dealing with them, I know I'm dealing with really, really intelligent people, because I can tell by their conversation and type of decisions that they make and the questions that they ask me about the market. I know I'm dealing with really, really insightful, intelligent, inquisitive, sharp people. OK, so because I believe that, I want to really try to get you to understand how to see the market from a different perspective, because you got to start asking yourself these kind of questions, as opposed to believing what analysts may be saying who are bullish on a company because they have clients who are in these particular positions, and also because they may have a position in it, or they may want to do business with these particular positions, because when they do an offering and it goes through a bank, well, the bank manages that. So a lot of times the bank may not want to be bearish on the company, because they want to manage that relationship and keep that relationship intact, because they want to do their next offering. So the financial institutions or the financial space, everybody is so tied into each other. you have to have the ability to get with you and your group and to create, like I said, a bullish and a bearish presentation for why you think something's going to move the way it's going to move, and the implications of a thing not going the way you think it's going to go. Always ask yourself when you get into a situation, what is a scenario in which things don't go the way I want it to go? So if we believe that these companies are good investments because there's a lot of pent-up demand, what's a scenario that we can create where the pent-up demand doesn't come back? And then how do we react to that? So what's our defensive plan as opposed to just our offensive plan? And so don't let somebody come at you with a story where for everything's going to always go the way you think it's going to go. That's how you're going to be successful. Because it's just like with football. You know, you could game plan for a week. You go out there on the first play of the game, your quarterback gets his leg broken. The question is now what are you going to do? Because if you haven't thought about that, then the game is over with. So you got to go into the game thinking about if we lose our starting quarterback, what is going to be our next move? So you come into the game anticipating there's a potential that our starting quarterback could go out. So not only do you have a plan for the starter, you also got a contingency plan for the backup, right? Then you may have another plan where if the backup gets hurt, because I've seen that happen before. So you want to understand, as an investor, I want to really encourage you to, create your own analysis, and you may have a bullish case study, but then also create a bearish case study. What happens if things don't go the way I want it to go? Then how I think that is going to affect the share price. And then if I think that I don't want to take the risk associated with that, how likely is that to happen? If I don't want to take the risk associated with that, maybe I will be better served moving my capital to another area. So I hope this was valuable to you. If you want to learn about the highest paid part-time job in the world, how you can stop stealing time away from your family, how you can control some of your income, how you can get rid of income instability, how you can take control of your own life and get what you want out of life, how you can control your time, reach out to me about the highest paid part-time job in the world options training program. Having a lot of really good results with that. Reach out to me about the IPO lockup course. Having ridiculous amount of results with that. If you know somebody can get value from it, share it out. This is David W. Williams, also known as Diamond Dave. I'll talk to you later.